Good afternoon, I'm Mario Becker, founder and CEO of Das Family Office, a Singapore-based multi-family office and fund management company licensed by MAS. In the following video, I'm summarizing the events of the first half of 2024. I hope you're finding this useful. The first half of 2024 proved to be a very good first half for stocks, global equities, to a large degree because the hype surrounding Nvidia didn't abate. In fact, Nvidia continued to be very strong and drove all global large equity indices to new heights. That is the MSCI World Index, that's the Nasdaq 100 Index, but also the S&P 500 Index. So the first half was really all about Nvidia. What would Nvidia do? Do they have new customers? Will they slow down? Will they not slow down? So it was actually very interesting that everything was centered around this particular company. I've only seen this once before. That was in the late 1990s when everybody was talking similarly about a company called Cisco Systems. But that said, it helped global stock markets that did really well in the first half, especially indices that were heavily weighted towards Nvidia or single managers. Many of our quality managers, they also like Nvidia because of the high profitability of the company, but also the MSCI World Quality Index, which we've been talking about many times in client discussions. The same goes for India. India also continued to do very well despite the election. The election produced a little blip. Some may view this as a buying opportunity because the broad markets went down by about 10%. But in recent weeks, India continued to make new highs and is benefiting from the fact that it enjoys stability. And I guess global money is looking for alternatives to China, and India looks like the obvious candidate. But I would caution both India and global technology stocks, and specifically also Nvidia, have reached valuation levels where we really have to say they are ambitious, they are not cheap, and whoever buys at current levels takes the risk that these investments may not work so well in the coming months and maybe even coming years. Although India, I would say, is not as expensive as the technology stocks, but the global technology stocks, the so-called Magnificent Seven, they're truly expensive, and I would caution investors to continue to invest in these. Whoever holds them and has bought them at much lower levels, obviously don't sell your exposure. These are companies that we like for the long term. But if you're looking at putting fresh money to work, I'd suggest you wait for a correction. Currently, we're kind of witnessing a bit of a correction, but it's just been about 7 to 10%. That may not be enough to bring these stocks to valuation levels that are truly interesting for long-term investors. Apart from technology and India, we saw decent markets in Europe and Japan and also China in the first quarter. All of these markets kind of held up vis-a-vis India and America. But unfortunately, these gains are not completely lost, but some of these gains have already been lost because of the election in Europe and also the fact that in Japan, valuations are not as low anymore. They're only low if compared to America and India. And I think there's a sense that the yen weakening has probably come too far. Everybody is, not everybody, but many people are waiting for maybe a snapback. So Japan is probably not as exciting as the people were thinking sometime last year and also early this year. So we would probably advocate not as much Japan exposure as some people say. I think a neutral allocation is good enough if you like Japan. Apart from Europe, Japan and China, smaller company stocks also didn't have a great first half. I was hoping that we would see a bit of a turnaround because valuations are quite low, but that didn't happen. Yeah, maybe a quick word on China. Unfortunately, the recovery in the first half was just a flash in the pan. So we're already going down again after hitting, say, 20,000 in the Hang Seng Index. So we're quite prepared to ignore China at this stage. There's just no point investing there. In as much equities had a very good first half, for bonds it was more differentiated If we're looking at government bonds, especially government bonds with medium to long durations, they suffered a little bit because US inflation didn't come down as fast as hoped for, which is why some of the interest rates that we saw at the beginning of the year, the 10-year Treasury was trading at around 3.75 and the 30-year was at yields of about 4%. They retraced back all the way to 4.75 and currently we're at about 4.25 for 10-year Treasuries, and for the 30-year Treasuries we're at 4.50. And rising interest rates always means losses in bond holdings. This is why long duration bonds such as our investment building block G1, which invests in long dated US Treasuries, has come off quite a bit, very high single digit losses. And normal duration bond indices like the Barclays Global Aggregate Index, which holds most global investment grade bonds, is down a little more than 1%. But if we're looking at specialty bonds, say high yield bonds, say tier 1 capital, or also emerging market bonds, they did pretty well actually. So these bonds are less linked to duration and they typically also have lower duration than government bonds. So they have typically their own life. They're dependent on credit quality, they're depending on the quality of bank capital. And across the board, these bonds did very well, including also Asian high yield bonds, which had effectively 2 terrible years. At this moment, if you look at our high-rise or skyscraper chart, which we always publish alongside our quarterly publication Reflections, which we're also posting under this video, you can see that valuations for these specialty bonds are truly attractive and in many cases are as high as long-term equity risk premia. So we're quite open to adding these to portfolios at this point in time. That doesn't mean that we would create a core portfolio around such bonds, but we definitely like them to supplement global equities and global bonds. Then commodities actually also had a good first half, probably because China is stabilizing and China is typically a big source of commodity demand. And we also saw very good development in the gold price. This is a trend we've seen for several years now, and I guess we can safely assume that countries like China, Russia, they just like to buy less US Treasuries, or they're less keen on owning US Treasuries. And an obvious alternative for them is gold. China produces a lot of gold and doesn't sell any of this gold. It keeps it in the country and seems to also buy on the global markets. In addition to the Chinese government, it's also Chinese individuals who've been burned with Chinese properties and stocks who are also buying gold, hoping to find a safe home for their money. So after a decent first half for at least global equities and to some degree specialty bonds, but not government bonds, what can we expect for the second half of the year? We're now at the end of July and we can already see a lot of changes compared to the end of June. July 11 produced a very good inflation number in the US, and as a result of that, we're witnessing some kind of rotation in US stocks. We see a fair bit of profit taking in the so-called Magnificent Seven, and we also see a rotation away from the idea of artificial intelligence being the huge opportunity towards neglected market segments. And in as much interest rates may come down because inflation has come down as expected, and we may see the first rate cut by the Fed in September, even before the US election, that is. Markets seem to be looking at opportunities that benefit from falling interest rates, and for many market participants that's to be found in smaller company stocks. We could already see that despite recent weakness in AI stocks, Nvidia, the Magnificent Seven, the so-called Russell 2000 index, which holds the 2,000 smallest companies in the US, is doing quite well. It's been up double digits despite the fact that the Nasdaq couldn't hold its ground. And this rotation may continue because the valuation for US smaller companies and also global smaller companies is quite low. So finally, what I've been advocating for the longest time, and people who know me know that I'm personally exposed in this segment and have been waiting for better days. So this may finally come. So if you're interested, you may want to look at the Russell 2000 index, the S&P 400, the S&P 600 index, We've recently also identified so-called quality ETFs on these particular market segments by Invesco, which intrigued us. So that could be an opportunity for the second half of the year. So inflation seems to have disappeared as an enemy. Then obviously we have the US election coming, and that will normally produce a certain amount of volatility. But the fact that interest rates are coming down should probably weigh more than the volatility surrounding the US election. So we're not too worried. Where we are, I wouldn't say worried, but where we'd like to continue to caution is we always like to look at valuations. So if customers come to us and say they want to invest, we will always look at what the opportunity set is like. And at the moment we can really say that global assets, fixed income assets are actually very attractive. We see in some fixed income segments, we see yields, target yields that are as high or higher than long-term equity risk premium. So in some segments, we're looking at 7 to 10% return, which is remarkable. And I think one should benefit from these and look into those. At the same time, India is not cheap. I wouldn't say it's excessive, but it's not cheap, maybe fully valued. So it may need a while, a couple of quarters, maybe a year or so to make current prices look more attractive, because we assume good company earnings in the year to come. But where we'd really be careful is the Nasdaq 100 and the Magnificent Seven stocks. Hardly with any exception, because maybe Meta and maybe Alphabet don't look that expensive. But if I look at Apple, if I look at Nvidia, if I look at Microsoft, these are stocks that we find in a lot of portfolios and a lot of indices. They're not cheap. It's nothing crazy like in the late 90s, but it's very ambitious. These companies trade at 30 plus times earnings, 25 times cash flow. So if we invert these numbers, we arrive at equity risk premium of 4%, which is not very attractive. Yes, these are great companies and they will certainly do well down the road, but it's not a great entry point. So we'd be careful here. So net, I think at the half-year mark, it's been a really good journey so far in 2024. And as always, it pays to buy quality. We're seeing a lot of quality in the market, so don't worry. Even if there's a lot of noise surrounding the US election, markets are attractive. If you have money to put to work, don't hesitate. Yes, the period between August and October, November is often very volatile. This may also be the case this year, especially in the run-up to the US election. But valuations are good. So if you follow your investment time horizon concept, which is what we're advocating, that means you invest money according to when you need it. That means if you need it soon, you don't take equity risks. If you don't need it for a very long time, you should take equity risk, even if there's a little bit of volatility in the near term, and you will do very well. We're excited to work with you, so don't hesitate to reach out to us. And all I can say, have a wonderful summer.